For centuries, the commercial insurance industry has priced risk using a single mathematical assumption that historical data accurately predicts future failure. This works for deterministic software, the legacy paradigm where a specific coded input reliably produces a specific engineered output. But Agentic AI operates on a probabilistic paradigm. Instead of executing rigid rules, these systems use delegated authority to branch and adapt based on live data. Because these agents learn and execute autonomously, their behavioral profile changes over time. This phenomenon, known as model drift, means the risk profile an underwriter evaluates today may be entirely different 6 months later. This shift creates a structural friction with traditional actuarial science. The mathematical models used to allocate capital reserves depend on predictable failure distributions, which these fluid systems do not possess. Since autonomous systems do not fail in repeatable ways, a significant exposure gap is opening between existing corporate liability frameworks and the probabilistic reality of modern enterprise workflows. To accurately price risk, underwriters require stable failure distributions. They need to know how often a system fails and how severe that failure will be. AI heuristic engines break this math. A system might generate a correct response to a complex query 99 times, but then confidently generate a disastrously incorrect response on the 100th time, rendering historical loss data irrelevant. This is compounded by the black box causality of deep neural networks. When a failure occurs, the lack of a transparent reasoning path makes it exceptionally difficult for insurers to prove proximate cause. Within a standard annualized policy term, the agent's behavior drift can render the initial risk assessment obsolete, creating an operational profile that the original contract never contemplated. Without a stable failure rate or traceable logic, standard frequency-severity models remain paralyzed. For capital providers, this lack of transparency makes traditional risk pricing inaccessible. To determine if a novel risk is actually insurable, the industry applies Berliner's insurability criteria, the standard framework for evaluating market viability. This framework highlights the first major hurdle, the randomness of loss occurrence. As the actuarial criteria row indicates, the complexity of AI makes it difficult to assess whether failures are truly random when systematic validation is lacking. Because AI outputs produce novel, unstructured risks, like misinformation, they fail the requirement for a uniform loss distribution. Further down, the information asymmetry row reveals a deeper conflict. Insurers struggle to verify how businesses manage AI risks, creating high potential for moral hazard. Proprietary algorithms and modified open-source models create a massive blind spot. Insured parties may neglect system integrity, while higher-risk organizations are the most likely to seek coverage. This asymmetry is hardened by a total lack of historical loss data for autonomous agent incidents, leaving underwriters with no baseline for evaluation. When measured against these market criteria, probabilistic AI remains structurally uninsurable under legacy models, forcing carriers into a defensive, exclusionary posture. To protect their capital, major carriers are aggressively ring-fencing their portfolios. They deploy absolute exclusions to prevent silent AI exposure, where digital risks inadvertently trigger claims on traditional policies. This leaves corporate risk managers in a coverage void. As this matrix demonstrates, they are often forced to patch together fragments of coverage across policies that were simply never drafted with autonomous digital actors in mind.
This fragmentation conceals a dangerous negligence trap. Traditional technology errors and omissions policies require the claimant to prove negligence, a failure by a human to exercise a standard duty of care. Proving human coding negligence is a legal dead end when an autonomous system is functioning exactly as mathematically designed, yet still produces a disastrous, non-deterministic hallucination. Meanwhile, vendor contracts frequently cap the liability of the AI developers, leaving the enterprise deployer to bear the full financial burden of third-party damages. Any organization assuming that existing cyber or liability policies implicitly cover autonomous agents is operating under a dangerous operational fallacy. For insurers and reinsurers, the ultimate threat is aggregation risk, the possibility of a single event triggering simultaneous claims across thousands of policyholders. The modern AI ecosystem is built on a highly concentrated architecture. Thousands of downstream companies rely on a small oligopoly of foundational large language models. Unlike a localized bug, foundational models act as a shared central nervous system for the global economy. If a reasoning flaw hits one of these core architectures, it could simultaneously trigger catastrophic losses across every downstream organization using that model. This digital threat mirrors the systemic impact of a massive natural disaster, but it operates at the speed of digital execution, crossing borders instantly. Traditional capital reserves cannot absorb this level of correlated loss. This fear is what forces the industry to demand radical structural isolation before they will provide significant coverage limits. To bridge the gap, underwriters are borrowing risk management concepts from existing domains that already deal with autonomous entities and high-risk algorithms. The first proxy is autonomous vehicle liability. Insurers rely on the operational design domain, the specific, tightly defined conditions under which a system is certified to function safely. For digital AI, insurance requires strict digital boundaries, specifying the exact databases, APIs, and financial thresholds they can access. The second proxy is high-frequency algorithmic trading. This provides the template for handling autonomous decisions occurring too quickly for human intervention. To be insurable, an AI agent must feature digital circuit breakers, automated rate limiting, and anomaly detection gateways that halt erratic workflows before financial damage compounds. By forcing probabilistic models into these highly constrained paradigms, underwriters create the predictability required for risk transfer. As the industry matures, it is moving from defensive exclusions to specialized affirmative coverage, such as technology performance warranty insurance. These parametric structures bypass the negligence trap. They pay out automatically if an AI model fails to meet objectively measurable performance thresholds, like minimum accuracy rates. But this capacity is only available to organizations demonstrating strict adherence to auditable governance frameworks, like the NIST AI Risk Management Framework or ISO 42001. Underwriters are now demanding verifiable proof, immutable audit trails of model decisions, robust data provenance tracking, and human-in-the-loop controls for any high-impact action. Organizations that cannot prove this governance will find themselves wholly exposed. Non-compliance results in exorbitant premium hikes or the total denial of coverage. Effectively, the insurance industry has become the primary gatekeeper for autonomous deployment. For any enterprise seeking to scale these systems, auditable governance is no longer a compliance choice. It is the baseline requirement for securing risk capital.